You pictured this for 30 years. The morning coffee on the porch. The grandkids on weekends. The fishing trip you finally booked without checking the calendar twice. The 401k statement that finally feels like enough. You did the work. You earned the quiet. And then you sat down to choose where to live the rest of it. But there's one number sitting under all of that, and almost nobody runs it before they sign the closing papers. Pick the wrong state for the wrong reason, and that number can quietly bleed your retirement of about $14,000 a year. Same couple, same income, same lifestyle. One state hands you the porch, the other hands you a bill. That's not a typo, that's the trap. Multiply 14 grand across a 25-year retirement, and you're staring at $350,000. That's a paid-off bungalow. That's 5 years of long-term care. That's the inheritance your grandkids will or won't get. The state you pick can quietly drain or quietly protect your retirement. The headline tax rate has almost nothing to do with which one happens. Here's what we're going to walk through. A 4-line formula you can scratch out on a napkin. The reason your county matters more than your state. The bills nobody warned you about. The ones that hit your driveway, your mailbox, and your dinner check. The income cliff that turns your dream state into your worst enemy overnight. And the one tax bill that can chase you across state lines after the moving truck has already pulled away. By the end, you'll know how to leave a state without leaving a tax bill behind. So how does one state beat another by $14,000? Let's start there. Every listicle you've ever read repeats the same line. No income tax. No income tax. No income tax. It gets chanted like a prayer. Here's the catch. When a state doesn't collect one kind of tax, the budget doesn't disappear. The roads still get paved. The schools still get funded. The sheriff still gets paid. That money has to come from somewhere. And somewhere is almost always you, just routed through a channel you don't see on any pay stub. Take a real planning desk walkthrough. A couple bringing in $72,000 a year. Some Social Security. A modest pension. A 401k draw to cover the rest. A home worth $340,000. About $42,000 a year in spending. Drop them in Pennsylvania, and the income tax on retirement money is zero. PA doesn't touch pensions, 401k, IRAs, or Social Security. Effective property tax around 1.5%. Sales tax 6%, with groceries and clothing untouched. Total state and local hit, about $6,800 a year. On the flip side, drop the same couple in Texas. Income tax also zero. But effective property tax runs 1.9 to 2.4% depending on county. Sales tax climbs past 8%. Vehicle inspection and registration take another bite. Total close to $20,900. Same life, $14,000 swing. 9 states wear the no income tax badge. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming. Look at your state. Wait for it. Because 4 of those 9, Texas, Tennessee, New Hampshire, and Washington, quietly land inside the top 15 most expensive states for a middle-income retiree once you add up everything else. The badge lies. So if the headline rate lies, what's the number that doesn't? There is exactly one number that matters. And you can compute it on a napkin before lunch. You've read the Kiplinger list, the Wallet Hub list, the Bankrate list. They rank differently every year, and that alone should tell you something. None of them know your house, your spending, or your withdrawal pattern. Each ranking is built for a person who doesn't exist, and that person isn't writing your tax check. You are. So you need a number built around you. It's called your effective retirement tax rate, your ERTR. For lines, pen and paper. That's it. Line 1. Take your real retirement income. All of it. Social Security plus pension plus 401k draws plus any Roth conversions you're planning that year. Apply whatever the state actually taxes on that mix. Write the dollar number. Line 2. Take the home you're actually going to buy, not the state median. Multiply by the effective property tax rate in the specific town. Write it down. Line 3. Take what you actually spend in a year on stuff that gets taxed. Multiply by the combined state and local sales tax rate. Add a small bucket for excise, the gas tax, the registration, the recurring fees. Write it down. Line 4. Subtract. Senior exemptions. homestead credits, pension exclusions. The carve-outs, the rankings flatten into a footnote. Total the 4 lines, divide by gross retirement income. That percentage is your ERTR. Take the Garcias for example. $80,000 in retirement income. A $300,000 home in Pasco County, Florida. $45,000 in spending. Income tax 0. Property tax around $5,400. Sales and excise around $3,150. Subtract a small senior credit. Total roughly $8,050. ERTR about 10.1%. Now run the same Garcias in Hall County, Georgia. After Georgia's retirement income exclusion of $65,000 per person, state tax bite is about $300. Property tax around $2,700. Sales and excise around $3,330. Total around $6,330. ERTR 7.9%. Here's the kicker. Florida costs more than Georgia. The no income tax badge cost the Garcias $1,700 in year 1 alone. And it'll do it again every year they stay. Run the formula on the Hendersons next. Same $80,000 income, but now Texas versus Tennessee, 2 no income tax states. Williamson County, Texas, on a $400,000 house. ERTR lands near 12.8% once property tax does its work. Knox County, Tennessee, same income, same house value. About 11.1%, even with a 9.55% combined sales tax. Same flag on the front porch. Different bill. Forget the rankings. You just became the auditor. This is the moment most retirees redo the math, and most of them sit back in the chair. But there's still one variable the rankings hide, and it's not even the state. You don't retire to a state. You retire to a county. And that one zip code can cost you a new car every year. Property tax doesn't get collected by the state. It gets collected by your county, your township, your school district, sometimes a special improvement district you didn't know existed. Sales tax has a state floor and a local add-on. That can stack another 2 or 3 points on top. A few states even let counties pile on a small income surtax. So when you compare 2 states, you're comparing medians. When you actually move, you live in one specific county. 2 counties inside the same state can hand you wildly different bills on the same exact house. Picture a $400,000 home. In Travis County, around Austin, the effective property tax sits near 2.18%. Drive west into Kerr County out in the hill country, and you're closer to 1.35. Same house, same Texas, about $3,300 a year in difference every year, forever. Florida tells the same story. Miami-Dade runs around 1.06%. Pasco County closer to 0.86. Illinois is sharper. Cook County effective property tax sits near 2.10%. Drift down to Madison and you can land near 1.55. On the flip side, the same dynamic crushes Northeasterners. Westchester County, New York, runs near 2.5%. Tioga County, upstate, lands near 1.4. On a $500,000 house. That's $5,500 a year, gone every year just for the zip code. When you scroll a ranking, you're reading a statewide median. That may look nothing like the address on your closing papers. The rule is simple. Before you fall in love with a state, shortlist 3 counties inside it. Run the 4-line formula for each one. Don't average the state. Audit the county. And even after you nail the right county, there's a second tax bill waiting in your driveway. It doesn't come from the IRS. No ranking has ever counted it. It shows up every single year with a state seal on it. We'll get to that bill in 30 seconds, but first, a quick favor. If any of this is making you rethink a decision, please hit the like button and drop a comment. With the state you're looking at, it really does help the algorithm, and I read them. Now, the bills nobody warned you about. Trust me, the state always finds a way to bill you. It just hides the envelope. Start with the car in your driveway. In Virginia, South Carolina, Connecticut, and Missouri, your vehicle is taxed every year based on what it's worth. They call it personal property tax. It acts like a recurring vehicle subscription. A $45,000 SUV can run you anywhere from $650 to $1,300 a year, forever. And here's the catch. Some no-sales tax states, Delaware, Montana, New Hampshire, Oregon, quietly make up the gap with surprisingly high vehicle registration fees in certain counties. 2 cars in the household. You're handing over $1,500 to $2,500 a year, and not a single ranking subtracted that from your retirement budget. On the flip side, look past the driveway and into the gate. The 55 and over communities in Florida, Arizona, and Nevada, the ones in the brochure for the rest of your life. Beautiful pools, tidy lawns, and monthly mandates of $400 to $800 between HOA dues and CDD fees. That's a private tax. You can't vote it down. You can't negotiate it. It rises every year. $600 a month becomes $7,200 a year. Add that to your ERTR, and the so-called tax haven loses its halo before the second sunrise. One more layer. In Hawaii, Nevada, and a handful of resort-heavy Florida counties, tourism and resort surcharges quietly push restaurant tabs, utility bills, and certain services up by 3 to 6%. Locals pay them too. A retiree who eats out 4 nights a week can lose another $900 to $1,400 a year, just because the menu was priced for vacationers. So you've got the formula, the right county, and you've counted the invisible bills. But there's still one more trap, and it depends entirely on how much money you'll be drawing each year. Every state has a cliff, a point on the income line where the state that loved you suddenly turns on you. Almost every senior-friendly tax break, the pension exclusion, the Social Security exemption, the retirement income credit comes with a ceiling. Stay underneath and the state hands you a pile of breaks. Cross over and the breaks evaporate. Sometimes gradually, sometimes all at once. Most people only meet their cliff after they've already moved. Take Pennsylvania. Under about $55,000 in retirement income, PA is nearly free. Push past $90,000 because of larger required minimum distributions or a string of Roth conversions, and the property tax on a typical home starts eating every dollar you saved. Take Georgia. The retirement income exclusion runs $65,000 per person, $130,000 for a couple. $1 over and you're in regular brackets. Take South Carolina. The senior deduction is $15,000 per person and slowly loses its bite as income climbs. Cross $100,000 as a couple, and your built-in advantage starts disappearing. Here's where it gets sharp. If you're planning Roth conversions in your first 5 retirement years, moving 50, 75, even 100,000 at a time from your traditional account into a Roth, you are temporarily blowing past every cliff in the country. In those years, a state that looked terrible on paper, like Wyoming or South Dakota, can quietly become cheaper than the state you thought was your savior. After conversions wrap up, the math flips back. Timing your move matters as much as choosing the destination. Move in the wrong year and you eat the cliff at full price. And don't run that math just for you. Run it for your kids. If you convert now and pay the tax at your bracket, your kids inherit a Roth that grows tax-free for 10 years. Skip the conversion, and they inherit a traditional IRA with a tax bill the IRS times to your funeral. Every retirement state has a price ceiling. Cross that income line, and your dream state turns on you overnight. So know your ceiling before you sign the closing papers. And let's say you do everything right. You picked the state. You picked the county. You counted the invisible bills. You avoided the cliff. There is still one tax bill that can chase you across state lines. Here's the surprise nobody mails you. In California, New York, New Jersey, and a few of their cousins, leaving doesn't mean leaving. If you don't formally cut your domicile, and most people don't, the old state still considers you a resident. They keep billing you, sometimes 12 months after you turned in the keys, sometimes 18, sometimes longer. They send a notice, then a bigger notice, then an auditor. The basic rule everyone knows is the 183-day rule. Be out of the old state more than half the year. That's necessary. It is nowhere near sufficient. New York and California layer on what they call statutory residency. Hold a permanent place to live in the old state, even one you barely use, and they can still classify you as a resident. The auditors look for what they call domicile fingerprints. You still see your old doctor. You're still registered to vote there. Your driver's license still shows the old address. The electric bill is still in your name. Each one of those is a thread back to the old life. Pull enough threads and they pull you back into the tax net. Real story. New York retiree. Moved to Florida. Lost 38 grand in back taxes. One reason. He didn't change his driver's license for 14 months. On the flip side, here's how to actually leave. Switch your driver's license to the new state within the first 30 days. Register to vote in the new state and cancel the old registration. Move your primary doctor, your dentist, and your specialists. Update the address on every brokerage, IRA, and bank account. Rewrite your will and your healthcare directives under the new state's law. Retitle and re-register your vehicles. Update your address with the IRS and Social Security. Keep a simple log, a calendar, a credit card trail, even airline boarding passes, of which days you spent where during that first year. The point isn't to sneak. The point is to be able to prove. The old state will assume you're still theirs until you give them a paper trail that shows otherwise. And that auditor's bill doesn't die with you. It comes out of the estate. Which means the state your kids never lived in just took a bite out of their inheritance. You can pack the truck, sell the house, and still get a tax bill from the state you thought you left behind. So what does the whole picture actually look like? Choosing the right place to retire isn't a state-picked from a list decision. It's 6 layers stacked on top of each other. The headline rate is the surface, and the surface lies. Underneath is your ERTR formula. Underneath that is your county-level math. Underneath that are the invisible bills in your driveway and your mailbox. Underneath that is the income cliff waiting at a number you may already be planning to cross. And underneath all of it is the way you exit your old state, because the way you leave decides whether the bill follows you. Skip any one layer, and the best state's rankings become the most expensive thing you ever believed. There's no best state for retirees. There's only the best state for your retirement. Your income, your house, your spending pace, your Roth plan, your honest read on how long you intend to stay. So shortlist 3 states. Inside each one, shortlist 3 counties. Run the 4 lines for all 9 combinations. That's an afternoon at the kitchen table that can save you 6 figures over the years you have left to enjoy them. And remember, taxes are one piece. The weather, the drive to your grandkids, the hospital you can be at in 15 minutes. Those still matter. This isn't only about your retirement. It's about what crosses the table to the next generation, and whether the state takes a seat at that table. If you found this video helpful, please give it a like and share it with someone you know, who's planning a move in the next few years. Thank you for watching, and I'll see you in the next one.